This is Alan Bush with ADMIS. In the stock index futures, we are seeing a little pressure developing this morning. Of course, we do have Alcoa reporting earnings after the close today. The latest estimate is that they will report earnings of 6 cents a share after one-time items. Keep in mind that the Fed may be a bit less accommodative later this year. It was just last week that they released the minutes of their December FOMC meeting, which revealed that there was some discussion about possibly eliminating some of the quantitative easing either at mid-year or possibly at the end of this year. So this likely to be a bit of a bearish factor if they do become less accommodative, and we are already seeing interest rates starting to firm up a little bit. So that a negative for stock index futures, even though we are seeing some of the broad indices at 4-year highs. Also, another thing to keep in mind, the first year of a presidential term is historically the weakest, so that could be somewhat of a negative as we move into this year for stock index futures as far as the outlook for the balance of the new year. Over in the foreign currencies, seeing the dollar index working higher. Interest rate differentials are beginning to turn more favorable to the U.S. dollar, and we recently made a 5-week high in the U.S. dollar index. Seeing the euro currency under a little pressure, some talk that the European Central Bank could be easing interest rates at one of their upcoming meetings, although probably not at the meeting scheduled for this Thursday. Also seeing the yen bouncing from a 2.5-year low against the U.S. dollar now for the second day, but interest rate differentials are likely to continue to undermine the yen against the U.S. dollar. And I would not be surprised to see the yen falling to a new 2.5-year low within the next couple of weeks. And in the credit markets, with the Fed likely to be less accommodative later this year, I think this is a sign that the bull market is about over for the credit markets, although we are likely to stay in a broad trading range over the near term. But the fact that the Fed now talking about how to alleviate some of the accommodation or reduce the easier credit has to be viewed as a topping signal for the credit markets. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.
But